Every single day, as an investor, you're just hit with this tidal wave of information, right? Breaking news, stock prices bouncing all over the place, nonstop social media chatter. It's a lot. And, the biggest challenge we face isn't finding information, it's figuring out what actually matters. So how do you find the real signal in all of that deafening noise? And that really brings us to the core question of this whole thing. When you make a move, any move in the market, is it a calculated decision that's based on a real fundamental signal, or are you just reacting to the distracting and, let's be honest, often misleading noise of the day? So to answer that, we first have to get crystal clear on the difference between the two. And I'm telling you, learning to distinguish what's truly important from what's just a distraction is maybe one of the most critical skills you can ever develop as an investor. And the distinction is actually pretty simple when you break it down. Think of it this way. A market signal, that's the fundamental stuff. It's information that helps you understand a company's real underlying value, and it sticks around. We're talking things like sustainable earnings growth. Now, noise, that's everything else. It's short-term, it's random, it's emotionally charged, and ultimately, it has no real impact on long-term value. So what does this noise actually look like in the real world? Well, you see it every day. It's the second-by-second price jumps, the breathless headlines designed to make you click, and of course the unverified rumors spreading like wildfire on social media. All of it is designed to create this sense of urgency, right? Pushing you to act on what is usually just random market jitters. Okay, so this brings up a really fascinating question. What if there's a tiny repeatable signal that's hiding inside all that noise? Could you actually use a small timing advantage to get an edge? Well, a recent study decided to put that exact idea to the test. All right, so here's what the researchers did. They looked at 22 years of data from India's Nifty 50 index, and they compared two really simple automated investment strategies. Strategy 1, you invest on the first trading day of the month, when a lot of people get their paychecks. Strategy 2, you invest on the monthly futures and options expiry day, which is a day that's known for being pretty volatile. The question is simple. Does the day you invest actually matter? And you know what? The initial results were genuinely surprising. This chart here shows the difference in the compound annual growth rate, the CAGR, between those two strategies. See how in most years those blue bars are positive? That means the strategy of investing on that more volatile expiry day actually did better. I mean, look at 2013. The difference was over 2%. At first glance, it really looked like they'd found a small, predictable signal you could actually exploit. And this wasn't just a fluke. The results were statistically significant, which is just a fancy way of saying it's highly unlikely this happened by random chance. But the key thing to look at here is that effect size column. Think of it as a measure of how meaningful the difference actually is. As you can see, it grows from medium over 1 year to very large over 5 years. So, in the short term, this tiny timing advantage was compounding into a real, tangible difference. But here is the million-dollar question. Does this little edge last forever? I mean, what happens when we stop looking at 5 years and zoom out to 10 or even 20 years? This is where the story takes a really interesting turn. Because when they did zoom out, the picture changed dramatically. This chart breaks the data into 5-year chunks. And that advantage, that difference in the annual growth rate, it just shrinks and shrinks and shrinks over time. As you move from the first 5 years to the last, that outperformance we saw earlier almost completely disappears. The signal just gets drowned out. This table makes it impossible to ignore. Over 10 years, that difference in annual growth was just 0.07%. Over 20 years, it was a tiny 0.03. What this means is that while the timing trick felt like a big deal early on, over the long run, it becomes economically meaningless. The signal you thought you were exploiting just faded right back into the noise. But wait, the study uncovered an even bigger reality check. You know that widely advertised 12% average return you always hear about for index funds? Well, over the entire 20-year period of this study, the actual pre-tax average return for these systematic plans was closer to 6.7%. That is a massive gap between marketing hype and reality. Okay, so if chasing these tiny timing advantages is ultimately a fool's errand for long-term investors, then what is the real signal we should be looking for? Where does a true, lasting competitive edge really come from? Well, the answer seems to lie in what the legendary investor Howard Marks calls second-level thinking. Now, this isn't some secret formula. It's about developing a deeper thought process. It's about looking past the obvious first-level conclusion to see the opportunities and the risks that everyone else completely misses. And look, this idea is backed up by decades of research. Burton Malkiel, in his classic book, A Random Walk Down Wall Street, showed that even professional fund managers who try to time the market consistently fail to beat simple passive indexes over the long haul. The data is just overwhelming. Time in the market is vastly more important than trying to time the market. This quote just sums it all up perfectly, doesn't it? Movement is not the same as opportunity. The market is always moving, that's the noise. But that constant motion, that frantic activity, it's not the same as a genuine investment opportunity. The real signal is much rarer, and it's usually a lot quieter. So let's bring this all home. If the real signal isn't some market timing trick, but a different way of thinking, how do we turn that into a repeatable strategy? Well, the most powerful signal is actually an internal one. It's your own discipline. This really comes down to 4 simple habits. 1. Filter. You have to deliberately ignore most of the noise out there. 2. Define. Know exactly what a real signal looks like for your personal strategy. 3, and this is by far the hardest part, wait. Do nothing until your specific criteria are met. And finally, 4. Commit. When that real signal finally shows up, you act with conviction, not emotion. So the ultimate advantage, it isn't being the fastest or the most active trader. It's having the discipline of a great baseball batter. It's the patience to ignore all the bad pitches, all the noise, and just wait for that one perfect pitch right in your sweet spot. You only act when your strategy truly aligns with the opportunity. That is how you turn down the noise and finally hear the signal. So, we'll leave you with this to think about. The market's noise is constant. It will always be there, screaming for your attention. The real question is your strategy loud enough to ignore it?